Good morning, a video morning brief of the U.S. stock market Monday, December 23rd, 7:57 a.m. Eastern Time. I hope it's warm where you are. We've seen zero this morning, actually a little below zero, recovering quickly, however. All right, what we have is that over the weekend they fixed the debt problem for the government or spending problem. However, as usual, it's a kick down the road here. There'll be things going on in January, I believe. There's going to be things going on in March, okay? And Trump didn't get what he wanted, and so there's all kinds of political disarray and complications going on more on the Republican side than Dem, but there's the typical Dem and Republican complications. The economy's still hanging in there, doing well, but there's increased discussion that we might be setting up for a recession. We see this come and go often. We might be setting up for a bear market. We've seen this come and go. We have the Hindenburg indicator I'll talk about in a moment is bearish. At any rate, they're looking at the 6-hour chart of the U.S. stock market, or I should say the S&P 500 uses a proxy for the U.S. stock market. And we believe the model seems to have been correct in recent days. All these level 4s, they're now getting a little sloppy. That's typical. It comes and goes. The model is suggesting a level 4 top today, and it may already be in place for the futures, but we can't come up with enough data for the cash markets, the day session. So I think we'll see stable to somewhat higher today, but as I look out tomorrow, the stock market should be down. I think the bigger move is down. The more time over the next 24 or 48 hours is down. I don't know how much to anticipate for down. Likewise, we don't know how much to anticipate for upside because it is a holiday week. People are trying to get out the door and go on for their Christmas. Some people aren't going to trade this week if they can help it, and they're not going to show up for work if they can help it. But they all watch the markets day and night, the professionals that is, are most of them. And they may suddenly get dragged into trading whether they want to or not. Just depends who pushes the buttons, who blinks first. So the current estimate is that the futures market can bounce a little today, but as far as I'm concerned, it ought to go lower. And I think if you start seeing it go on down to 59.71 in the futures, I think it's probably over and done with, ought to be lower into tomorrow. Now, this is the hourly chart, seems to be behaving fairly well, even with erratic behavior last week and knee-jerk reaction towards the end of the week. And I think it needs to go back down and test recent lows. Let's go ahead and move to the daily chart, and we'll go to the S&P 500. And it dipped into our level 1 target that can also may only be level 3. It's all kinds of targets from now into early February for downside. It dipped into the gap that was created in November. It bounced back Friday to a moving average, and we've got the 5-day moving average coming down to it. It bounced back into a former downside target that we now are suspicious is an upside ceiling, if you will. So it bumped its head. If it starts back down, they're going to get nervous. It's going down to the next moving average. I believe it's the 100-day moving average at about 57, 51 or something like that. And I think it should completely fill this gap. I think it's going to get down there. What I can't tell you is it may not get down there for this level 3 downtrend. It may get down to those prices or even lower on future level 3 downtrends inside of a larger level 2, level 1 downtrend, all right? So from this low, which we're using as the level 3 bottom, it was too soon on Friday for level 3 bottom. It should go down and take out that Friday's low, ideally, and move lower still and do it this week. The problem is because of the holiday, because of fixing the government story, and the lack of other types of stories, I'm a little concerned it might only pull back some and not do the ideal. It just pulls back, hesitates, puts in the level 3, and still rallies anytime from this week into next because they're determined to have something that looks like a Santa Claus rally. And I do not believe that'll put it to a record high, and it's going to still be a poor or modest Santa Claus rally, but it could pick its head up and still be stable to higher right into the start of January. But the best guess is they're going to bottom it out this week, bounce it only for a day or two going into next week, and then it's right down again. I don't think it's going to be a good Santa Claus rally, okay? Now, we have the Dow Jones Industrials. That blasted below a moving average, come down, test the moving average, started to bounce. This is the cash, all right? So that's what it did as of Friday. It may bounce back to a moving average and a crossing 5-day moving average. So that's a crossover, maybe a bearish signal for some, but it's not one of the more famous ones. It is still oversold on the daily chart. So yes, it can rally. All I'm saying is, yes, it can rally now, but if it starts back down to this moving average, they're going to get scared. It can go back down to the next moving average of 47.11. These are live moving averages. They will bounce around a bit, okay? Then if we go to, if I can find one of the cash indexes for the NASDAQ, it always seems difficult on this chart. There it is. This is the NASDAQ cash. It finally got on board here, trying to catch up with the weakness in the Dow Jones and the S&P 500. It bounced Friday back to a 5-day average and immediately sold it and then came back some. Again, I think there's more downside here when I look at these specific charts. When we look into, say, the equal weighted index, it looks very ugly along with the Dow Jones, but it's also due to blip up, but it might put its top in even this week. We might go from a bottom to a top, and I need to assess, is that possible with the S&P 500 and NASDAQ? Because it is with the Dow Jones and it is with the equal weighted index, okay? Now, let's go to the futures, throw in some analysis here. And what we have is, this is a level 3 top for the futures continuous chart. It may be a bit different looking at other charts. It may have occurred a little earlier, and that doesn't matter. It's a slight distortion. But what we're looking at is it should pull back and ideally go below Friday's low. And this is today's price action right here, flirting with the 5-day averages, okay, of open and close. Close is the most important for most people. And it should pull down and ideally go lower than that into a level 3 bottom, then pick its up for a level 3 top, then down again, and I think lower still for a larger trend. However, it can bottom as a retracement, meaning it just pulls back some, kind of settles out, puts the bottom in, then it moves up. And the more it refuses to come down, the more potential upside. So I'm not saying we can't get something going here and get these Santa Claus rally type stuff going, but in my opinion, it should not. This is the weekly chart of the S&P 500, and last week it slammed down to our fair valuation. We're still studying that to see if we need to adjust it. Can we get any clues from the market itself to adjust it? And that is included in that kind of modeling. It bounced off that fair value as though it was working. And somebody woke up saying, hey, this is a bit insane of what we've done, a little too fast to the downside, all right? So they can bounce this up, but I still believe we've seen a level 1 top over the past 1, 2, 3 weeks, even at the record high. You take your pick which it is. I don't particularly care. The model doesn't seem to care right now. We'll worry about that later for future timing of level 2, level 1s for top sell signals. The trend ought to be down to January, and the model now is a little more pushy that it will be January 6th or later, and it might bottom as late as early Feb. At the moment, we're thinking a January bottom. We're thinking ideally it should go lower than last week's low, okay, which was 5835.81. Now, there's also someone who is watching, famous technical analyst, who's watching 5850. He said he didn't want to see that break, or he is nervous that some of these bears may finally be correct, okay? Now, the Hindenburg indicator has been tested or used over a few decades now, and there's like 18 sell signals it gave. Some of them were very, very important, like the sell signal of a decade. Others were like the sell signal of our LT3 right here, this minor long-term top that may be there or may not, because it may be back in July, and I've discussed this many times, and it's a weird one, a difficult one to deal with. But there was other times that the indicator gave a sell signal and the market only went down an additional 1 or 2 weeks, and other times for a couple of months. And I learned those were basically level 1 bottoms, maybe level 2s. I included those, meaning some people would say, gee, you're making the indicator look better than it did. Well, it came up with 61% accurate. So the point is, other people would probably reduce that and say it's really only a 50-50 kind of indicator. But when you looked at those bear markets and those moves, it sent a message to me, we should still take it seriously. And when you read about what goes into that, what the person that designed that, what he came up with. Very interesting. I think it's as good an indicator as anything to keep an eye on, and it is bearish. And the interesting thing is, it did call the top in 2020. It did call the top in 2022, actually December 2021. And my model gave a sell signal in January. So we do have to consider things might be quite bearish. We have to consider they could be bearish all the way to October now. But we also have to consider if it's a record high after February, we should assume, even if we haven't found that minor long-term LT3 bottom, that it's unlikely we're going to see like a 20% down move. It's unlikely we're going to see a real ugly bear market all the way to October. We're probably just going to see violent, volatile, brief breaks at times. And I still think we'll see a -7, -11% sometime next year. But I don't think we're going to see the definition of Wall Street's definition of a bear market, okay? But until we get that record high after February, there is a chance that the model is too optimistic bullish, that so are all the bulls, even myself. Things could get ugly in coming months and stay down for a long time. It could stall out, go nowheres for a long time. That's not the best forecast, but we have to put it on the table knowing the history of these LT3s and the model timing of them. But now that we have that Hindenburg indicator, along with other indicators, along with some deterioration of breadth, meaning people have been selling across the board, and they were trying to hold up those handful of stocks, the Mag 7s, and it worked for them for a while, and then they just had to give in, okay? Now, the Dow Jones and NASDAQ look similar to the S&P 500 now on a weekly basis. The NASDAQ has dragged its feet, held up the best. This is the Mag 7 now, and we believe it's put that top in. We believe it's going down into January, but it still is stronger than the others. It might do something here to hold up better and have a Santa Claus rally better. And even though we're bearish into January, it could come up with some targets much lower. At the same time, we can't rule out we've all basically seen the worst, and it's just going to flounder around a little bit till it puts in that bottom. It depends how bullish it is long term, what else is coming for bad news, good news. This is NVIDIA, and it can be in a long-term bear market for months like the rest of the index and can even break away and do its own thing. But it also may just be bullish or bearish for just a few weeks here and turn up and may even bottom out ahead of the overall market. Okay, now interest rates, of course, have given the market a problem here. And it looks like this morning interest rates are willing to go up again. And this might help bring the stock market down. It might help cancel the Santa Claus rally because we think interest rates are going higher into January. We're having a difficult time saying, is it going up a huge amount, small amount? Is it going to flounder around into the top? There's all kinds of scenarios. But we're thinking, ideally, it's got higher to go, and that could be one of the driving factors to bring down the stock market. And the same can be said of the dollar. The other things like gold, Bitcoin, they're not bothering the stock market. The stock market has to do its own thing and take care of its own business. All right, so in summary here, as we get started for the holiday week, and it's going to be a short week because the markets are closed Wednesday. I don't know if the futures trade on Wednesday or not. I don't particularly care. What we've got then is this is the 12-hour chart of the S&P 500 futures, and they've backed off here. We have them up 5.5, but they've backed off from overnight. And again, as summary, I can see the market ticking up today, but I think it ought to be down tomorrow. And I think there's more downside potential than upside potential today, tomorrow. But I also can see the market doing a whole lot of nothing here for holiday week. And it really ought to back off some for a level 3 bottom. Doesn't have to go lower still than last week, although it normally would, but I don't think we're dealing with a normal market here. And then I think by next week it'll probably be up some. And then it should be back down again. And I think these zigzags, of course, are going to occur for level 3s, level 4s. And somehow they're going to have a bias that can be bearish into the week of January 6th on into early Feb. and we can put this market down a small amount, we can put it down a large amount. There's all sorts of scenarios of how's this news and information going to come into play, okay? And for the moment, it still looks like we're in a long-term bull market into 2026, 27. We're in a major long-term bull market with background of super cycle bull markets that could put it bullish to 28 to 2031. But right today, we can back this market off, and we may yet learn, because of the politics and policies related to politics, we may have something override some of this. And this year, 2025 doesn't have to be such a good year. And we'll just have to take it one step at a time, see how we develop it. But right today, I got to be bearish into January, and then we'll take a shot at being bullish and see if the bulls really step up to the plate and help out here. And can we get that record high soon after February? Are we going to get it even sooner? But even if we get it sooner, we still need to see a record high after February to tell us we're on the right track of a chance to be bullish in 2025. Otherwise, there is that chance to stall out and have a problem in 2025. Past results are not necessarily indicative of future results. Have a great day. Thank you.